Okay, the next model which we'll typically look at is the free cash flow based valuation model. Okay, what this model is simply saying is, so what this model is simply talking of is the dividend. Till now we have used dividend as a mechanism of cash flows. But in large number of cases, there may or may not be possibility of dividend. Because sometimes based on our calculations, it may so come out that the dividend may come negative. Even in one of the cases yesterday we got that. So when we are creating a model, it may even talk about zero dividend or negative dividend. Some kind of numbers can come out, which are not apt kind of a dividend in some kind of companies' cases. So in all the cases, dividend may not be a better mechanism to do the valuation. So that's where people have come out with an alternative called free cash flow to the firm. What it says is the cash that is available freely with the firm after taking care of operations and fixed investments. The cash that is freely available with the firm, which is like for its operations purpose or for running the business purpose, it has spent whatever it is required to spend. Probably for all operations, salaries, payments, or for manufacturing, raw materials, and even on buying, let's say, some assets, machineries, and all for that year. After it's spent on all these things, the remaining cash, probably it may do some investments out of it, right? But that is a cash that is available with the company. If it really thinks, it can give that cash to its investors. The whole cash, after I use, let's say I have some cash. Out of that cash, I'll really think how much is required for my business this year. For making all purchases, everything, purchases and even probably some capital purchases also. Everything. After everything goes up, how much cash is left with me? So that cash, what I am doing sometimes, I am either maintaining it in my bank account. That's not my cash. It's the cash of my investors. Correct? Either I am maintaining in the company's bank account or investing it somewhere else. Probably some other shares of companies or some other bonds or something. But that is a cash that is left with the company. Probably that amount can be paid to all its investors. That is what we call as the free cash flow. What is the cash that is available? Irrespective of whether it pays or not, what is the payment potential of the company? Whether it pays or not. If it does not pay, it will invest or it will do something out of it. Right? It will probably earn some interest on it or some returns on it by investing elsewhere. But it can, potentially, it has that much of cash which it can pay to its investors. And that potential is what we are calling as the free cash flow of the firm. So whatever is the cash that is available with the firm to pay to all its investors is what we are calling as the free cash flow of the firm. Right? Now, the way we are computing that free cash flow is the way we are computing that free cash flow to the firm is through this mechanism. We take the cash flow from operations. So cash flow from operations is the total cash that is used for all the operation purpose of the business, and fixed investments like capital expenditure, gross assets. So capital expenditure, whatever has been spent for that year, I'll remove that portion, and whatever is still the capital work in progress, these two are again used for operations itself, the real core business of the company. So these two things I subtract, and whatever comes is what I call as the free cash flow to the firm. So this is the historical free cash flow. Now, when I say free cash flow to the equity, whatever has to be paid to the debt investors, either in terms of principal repayment or interest repayment or whatever it is, that extra repayments that are being done, after I pay to the debt investors, the remaining is going to the remaining cash is available to the equity investors. So when I say free cash flow to the equity, it is the cash that is available for distribution to the equity investors. When I say free cash flow to the firm, FCFF, it is the cash that is available for distribution for everyone. It could be a debt investor as well as an equity investor. But after I pay to my debt investors in the form of interest and principal, I may do some extra principal repayment, I may do some interest repayment. After I pay to all those parties, to the debt investors, whatever is the cash that is left is what is the free cash flow to the equity. Now using the same, I'll try to forecast these numbers for the next 5 years, which is I'll simply drag this formula. So these are the numbers for the next 5 years. The free cash flow to the firm is going to be this much, and the free cash flow to the equity is going to be this much. Right? Free cash flow to the firm is going to be this much, and the equity is going to be this much. Now, the same logic I can apply. Just like the way I have applied the dividend, I can apply the free cash flow to the firm logic also. Now, the free cash flow increased at a particular percentage. Right? Now, let me see the way. So, probably these are the free cash flow to the firm and all for the next few years, and this is only for the equity, guys. So, probably I can take either the free cash flow to the firm or free cash flow to the equity. The only difference between the two is, if I take free cash flow to the equity, I'll have to discount it with the cost of equity. If I take free cash flow to the firm, I'll have to discount it by the cost of capital, weighted average cost of capital. That's the only difference between the two. Otherwise, both of them are one, and I can go with either of them. Now, okay, let's try to go with a free cash flow to the equity kind of a model or firm. Both of them will try out. Right? So I'll put in the valuation. Again, the same part. Let's say let me take this part as it is. I'll change the numbers wherever required. Let me take this part as it is, because a lot of things will be repeated. Year number will be the same. Yeah, probably let me take the year as exactly same as this. So these are my years. Then instead of dividend, I'll call it as free cash flow to equity. Equity investors, what is the cash that is available? So I'll say equal to Okay, I have to pull it from this sheet. Okay, first year I don't have, first year I have, no? Free cash flow to equity in the ratios. This is my free cash flow to equity. So I'll take this number, free cash flow to the equity, and probably I'll drag it to this layer. This is what is going to be my free cash flow to equity each of the years. Then, okay, here, now the other numbers I have to bring in. Now the free cash flow to equity, I have to, in the long term, I have to assume that it is growing at a particular rate. Right now, it has to grow over a period, right? Over a period, the free cash flow to equity is growing at a particular rate. From the first year, it is at this level, to the last year, it has gone to this number. So I'll say annual growth in the free cash flow to equity. Again, the same compounded annual growth formula is what I'll use. The last year value divided by the first year value to the power 1 by 4 minus 1. So there is almost a 15% growth in the free cash flow to equity. So what I'll do is this number, I'll equate it to this one, because overall I have to bring it down to around 5% in the long term, right? So the long term growth rate, let me assume that it is around 5%. Now here the difference comes. Free cash flow is not growing at 5%. Probably the economy is growing at 5%, but free cash flow, again, it may grow at 5% or 4% or 6%, whatever it is. Let's say, okay, even if I assume that it is growing at the same 5% rate, which means this 15% over a period has to come down to 5%. So here I'll take it equivalent to 5%. So what is coming? Over a period, this number is slowly coming down. But here it should come down as F31 minus, instead of F6, I need it as F31, and instead of K6, it should be K31. So it is coming down to 13 point something and 7 point and 5. This is how the free cash flow is falling over the period, right? Then, so this is what is my free cash flow over the next few periods. Now I can do the same logic, right? I am assuming that the free cash flow is growing at this layer. Now what happens is, okay, now we have to slightly discuss on this free cash flow growth. Dividend wise, we have said that the dividend is growing at 5% because dividend is directly related to my profit. Now, if the growth is just 5% in a year, if the sales is growing just at 5% in a year, right? At what rate is the free cash flow going to grow up? For that, what I need to do is, in the income statement here, for the next period, just to see what is the kind of growth in the free cash flow, in case the growth in the sales is just 5%. So what I'll do is, in this case, I'll just increase this sales one more year. I'll just try to increase it by 5%. Right? Nothing else I change. Only the sales I'll increase by 5%. Rest all I drag. I can do that. Rest all I drag. I'm just replicating the previous scenario. Then probably even in my assumption sheet, I'll put all these numbers. I'll put all these numbers a little bit of extension. I can do this for one more period. I've just extended them for one more period. Now even the balance sheet, I'll increase it by one more period just by dragging it. Just to see what would be the impact on the free cash flow. If the sales is growing at 5%, what would be the impact on the free cash flow? Right? Similarly, the cash flow also I'll drag it by one more period. I'm not doing anything big. Only just testing out in case the growth is only 5%, what will happen to the entire free cash flow? Right? Now, probably even the ratios, this free cash flow segment, I'll drag it. Something else got impacted. Sales has increased only by 5%. This is what has happened to my income. Income has increased by 4%. Costs. So final profit. Your profit before tax did not change. This is what has happened to the profit after tax. Why is this difference coming up so badly? Okay, reported profit also did not change much. Only 5% was the total growth, right? I think something in the balance sheet. Balance sheet has increased drastically. Income modified M5 divided by assumptions N81. Almost okay, 26,000 to 27,000. But what has happened to the assets? Okay, this has happened to the assets, and based on the assets, I have got that this is the investments. The cash has actually gone a little bit up. The retained earnings also has gone up only by this much extent. Okay. Cash flow, The profit is almost 100 more. Okay. The profit is 100 more. Okay, all these things added up. The cash flow from operations other income other income is creating the problem. Okay. Now what is happening to our free cash flow? Free cash flow has become from 2,789, it has become 3,100 or something. So what we are observing is the growth in this is almost around 11%. So even when my sales is growing at 5% itself, the free cash flow is growing even at 11% kind of thing, right? So the free cash flow is growing at a much faster rate compared to your sales. Even if your sales growth is around 5%, the free cash flow growth is something much more itself. Now what we can do as a part of our valuation is again the same logic whatever we have applied. We'll try to find out if at all it is growing at this kind of a rate, right? Which means every year it would be better that I take the growth at this particular rate. So whatever the rate I have taken now I'll typically try to find out, right, whatever is the rate the free cash flow is growing, we'll try to see that what is the terminal value. We'll try to calculate the terminal value, which is again the same logic. The last year value, this is the value last year, into 1 plus G, 1 plus G is this one, divided by KE minus G. Now again KE, I can use the same KE because the cost of equity is the same. KE minus G. So this is coming out as the terminal value. Then again I need to find out the PV of the terminal value. This is the PV of the terminal value, where I'll say the present value going with the rate being this much, 12.9 or something. Then the number of periods being 10. Then the PMT being 0 and the future value being this much. This is the present value of the terminal value, around 14,000. 2011. 2011, around 14,000. Then similarly I am saying PV of all the 10 years. years 1 to 10. PV of the years 1 to 10, it is telling me the sum of these numbers. Sum of all these numbers is for 1 to 10, another 14,000. So the total PV, this is saying, is around this number plus this number. Now we are seeing that the free cash flow was growing by almost 11%. So the long-term cost of equity, when I look at it with respect to the free cash flow, should be around 10% or 11%, because the growth is, even if you are typically having a growth of 5%, your free cash flow is growing at around 11%, right? So even if I assume that the cost of equity is going to be at the rate of 8% or 9% or whatever it is, or if I go with the current assumption itself, let's say 29,000 is the total value. But that is when I made an assumption that even the long term, the growth is at around 12.9%. But if I assume that it is only at 11%, the long term growth, just like the way we have dealt here, the long term cost of equity here we have taken it around 8.8 8 point some percent. So here also I have to take that number. So when I take the long term cost of equity here, the long term cost of equity here, it is simply coming out to, let's say, I take it around 8% or 9% or 10%, whatever it is. Again, the same 8%, let's say. Let me take it at around 8% here, which means the PV of the terminal value it cannot be this number. I'll replace it with this number. So it comes to something like this. Now I can very well find out what is the value per share. The value per share is coming out to this divided by the total number of shares. The total number of shares in our case comes from the income statement. The total number of shares is coming out to this much. So this says the value per share is only at around 1281 rupees per share, assuming that the free cash flow growth is more in these lines. So which means if it is available in the market at slightly higher price, it's more like overvalued, otherwise it is undervalued. Again, if I try to compare this with the market price, see, the best way is, because there are so many assumptions involved in this, 5%, 8%, these are all assumptions involved. So because there are so many assumptions involved in this process, the best way to arrive at the numbers in the long term growth rate typically is, okay, let me try to, if I say that this is 8% itself, let me try to change this long term growth rate. Instead of 5%, let me assume it to some other number, so that this number comes out more equivalent to the market value. So let's say the market price is some 1444 or something. So the difference for me is this number minus this number. So I'll try to use again a goal seek, where my objective is to make this equal to 0 by changing the long term growth rate. Probably if this is 4% or 6%, probably that number can come out. Now you see, if I take the long term growth rate to be around 6.07%, the market value is matching. Now what I need to do is, then probably let me assume the long term growth rate in both the cases as the same 6.07%. and try to do it. So here also what I can do is, okay, here again let me do the same logic. If I grow with the dividend, if I assume that this number has to be zero, with by changing not the, I'll change the long term growth rate in this case also. So it says if, I mean, the growth in the dividend should be only at around, the growth in the dividend should be at around 3.61% every year if I'm going with this approach. So in both the cases it is matching that 1440. Now, so which means whenever I am using it for a growth in dividend purpose, I'll say that it is a growing long-term growth rate will be at around 3.61%. But when I am using it for free cash flow purpose, I'll use it around 6.07% because I have derived it from the past data. Now I'll derive it in such a way that if I do it for 10 different companies, the error has to be as much minimum as possible. Probably it may not be 3.61 because I have done it for only one company. It has given me 3.61, but probably I may say it should be 4%. So the moment I put it equal to 4% for all the companies, what is the error? Depending on for what number the error is coming out to be minimum, I'll assume it to be that number and I'll make a decision on whether it is overvalued or undervalued. Depending on what, now when I say my assumption is changed, let's say the cost of equity assumption, now I'll change it to 9% in both the cases, not 8%. So which has made this value slightly different. Even in this case also, let's say I'll make it to 9%. In both the cases, I'll try to change again this number. If I assume that for automobile industry, the cost of equity is around 9% always in the long term, then I'll change it. Then this number will come out that the long term growth is around 6.55% for the automobile industry. And even in this case, I mean the FCFF growth, the free cash flow growth should be at around 6.55% for the entire industry. But for this company, we are seeing it's around 11% or something, right? Whereas similarly, when I look at it, in this case, the dividend growth, it will show me that it should be around 4.3%. Okay, now what I'll do is, I'll take this as input. I'll try to substitute the TVS Motors data. With the same input, I'll try to substitute the TVS Motors data. If it is giving more and more closer, I'll stick to this kind of a result. Now probably again trying to put the TVS Motors data. I mean, I'll open the TVS data sheet again. Now probably I will save this again. With either of the methods, I should generate something closer to the reality. Okay. Yeah, now going with this logic, we are seeing slightly better. Going with that 4.3% growth and all, we are seeing that TVS Motors, the share price should be around 48, whereas in the market it was 59 or something. So that's where I'll say that it is overpriced. And over a period, we have seen that it has come down itself. Right? Similarly, even through this method, it's only showing it should be 22 only. Which means both the methods are actually telling us that it is overpriced itself. Now, the mechanism, the better way to derive is, now when I've used these numbers, 6.55% or these kind of numbers, in case of TVS Motors, I am seeing that the error is much wider. Correct? But the decision is overpriced. But the difference is much wider. Now, what my intention is, for what numbers the error is much minimal with respect to the market price. So those numbers I have to take. Probably in this case, if I take the same, if I try to adjust, this number will change. But if I use the same number for Bajaj Auto again, the number will be, again it may say it is undervalued or overvalued. So I collect all this data for all the companies, and based on whatever I have collected, I'll see for what combination the differences are pretty minimal, are pretty marginal. Those are the numbers which I'll take. So it's not just one calculation, because if it is one single calculation, we will be affected like this. So we are doing it for a series of companies probably within the industry. See where the error is very minimal. Use that combination of numbers for better forecasting for the future. Right?